Hello, everybody. Good afternoon. As you can see, Carmelo Anthony is not on the stage right now. We had to move things around, so we're going to do this panel first and then follow that with the panel that was originally scheduled for this time. But I'm super excited to be talking to you all about this topic today. My name is Mekhala Krishnan. I'm a partner with the McKinsey Global Institute, which is McKinsey & Company's business and economics research arm. It's essentially our think tank that sits inside of McKinsey, where I lead all of our research on sustainable and inclusive growth. And so we're here today to talk about the topic of inclusive investing and how private capital can drive societies forward. Why are we talking about this today, and why am I super excited about this set of co-panelists that we have? We know that the topic of inclusive investing is one that's only becoming increasingly more important in the world today. Our sister institute, the Institute for Black Economic Mobility, for example, has looked at the various pillars of investments that we need to raise progress on Black economic mobility. And there's a varied range of investments we need, from everything ranging from affordable housing to financial inclusion to public infrastructure to addressing the digital divide. That's just one example when it comes to Black economic mobility, but examples of this kind exist across arenas. I spend a lot of time doing work on climate change. We need to spend trillions of dollars if the world is to achieve the goals set by the Paris Agreement. And so across different arenas, there are trillions of dollars of capital that need to be invested. Now, we're also recognizing that there is tangible opportunity from those investments. For example, one of the analyses that we did estimated that there's $10 trillion of spending that we would need to incur for the net zero transition in the next decade, $10 trillion, that is already cost competitive relative to traditional investments. And so it's investments that are in the money already today. And so we have a lot of spending that is needed. We're starting to see investable opportunities. We're starting to see capital flow. But of course, there's a whole range of challenges, ranging from how we think about prioritizing to how we think about managing trade-offs between financial returns and social returns, so on and so forth. And so these are the kinds of issues that I hope to delve into with the panel today. Let me do a quick round of introductions of this fantastic panel. We have Brun, who is the co-founder, chairman, and CEO of Ariel Alternatives. We have Greg Schell, who's a partner in sustainable investing with Goldman Sachs Asset Management. We have Swan, who is the inaugural head of the Ford Foundation's Mission Investments Program. And we have Taffi, Ayodele, who is the director of diverse and emerging manager strategy at the New York City Retirement System. So let me start with maybe a somewhat easy question to get us going, which is, what does inclusive investing actually mean? It's this big term. What to you sits underneath that term? What is in scope? What is out of scope?
Thanks, Mekhala. Great question. And the answer is whatever you want it to mean. From my vantage point, what it means is being able to invest both for appropriate financial return and impact, which to me is as inclusive as you can get, because it encompasses both the mercenary sort of economically driven motives as well as the sort of socially oriented motives. And I follow in the footsteps of lots of folks who had similar ideas, not least of which, for example, is Paul Polius, formerly Unilever's head, who was a big believer in net zero, if you recall, in terms of investing both for impact and for financial return, which I believe you can do. Now, we unfortunately live in an environment and an age where things run very hot and cold, and we're at a point in the cycle where it's not exactly politically correct to talk about diversity, not politically correct to talk about investing in areas that are underserved or investing with underserved communities. But I think the train has left the station, and inevitably over time, this is an overarching and overriding theme of how we will be investing going forward, and being able to do it with both a capitalist bent and an eye towards how you can affect lives that generate that economic return positively is the way that I think about inclusive investing.
And you think that synergy exists?
I think not only does the synergy exist, but I think it is permanent in terms of change. If you think about the transfer of wealth that's going on in the world, in this country in particular, the folks who will have the money are the folks who are mission-driven, who believe in these things, who will drive the holders of the bulk of that capital, which are largely the index fund, funds to invest in the ways that they believe are appropriate ways to invest. So, notwithstanding the current diatribe and vitriol against this kind of investing, it's where we're headed.
The market is sending the signal, and the train is
absolutely.
So, Greg, maybe I can bring you in here. Help bring this to life a little bit more. What's an example, maybe that you have actually invested in that you would put under this umbrella of inclusive investing? How did you develop the thesis? What was the success of that investment? Maybe you could give a couple of examples to the audience.
Yeah, happy to. First, can I confirm? Can you all hear us?
Yeah, there's a lot of echo for us.
Okay.
Yes. Thank you for asking the question.
It's hard to hear in the reverse. Let me join you in just being grateful to be here. Thank you all for saying, despite the fact that we're not Carmelo Anthony, so it's happy to be here. Recent example for me over the course of the last many years, this is the style of investing that I've been fortunate enough to practice. And I'm always excited for the next opportunity to find businesses who are out in the world really doing extraordinary things. And I would say a lot of the investing that we'll talk about, as intuitive as it is, and I'll talk about a specific example, it still somehow feels like an out of consensus idea, which is strange because on the one hand, the fundamentals are so powerfully strong. And on the other hand, the sentiment around it, is maybe impaired at some level. But let me give you a recent example. We just closed a deal in February, really for an education software business that really hits on the science of reading. Clear that we exist in crisis conditions in American public schools, especially in rural areas, especially in the urban core of the country. And so the need for remediation, and supplementation is acute at this moment in time. We had the opportunity to partner with a software business that really is about the science of reading, that which some high dosage tutorial is catching kids back up with respect to being able to read on grade level. And I'm certain if I polled this audience and asked you how many of American fourth graders are not reaching grade level in reading by grade 4, I'm certain that the consensus view would be too low. It's almost 65% of our American fourth graders that can't read on grade level. So when I say this is, emergent as an issue, clearly the country cannot continue to sustain economic preeminence without a talented and knowledgeable workforce. And if we're compromised, in our lower schools, there's just no way that you achieve the level of remediation possible. So here along comes this business that not only is delivering a really interesting solution, but its efficacy is so strong that it's really serving to erase the student achievement gaps that we think and see are so prominent with respect to both race and income and wealth, but also with respect to race. So that's a very intuitive reason for why a business ought to grow and become a larger business, is because the nature of the problem that they seek to solve and the value that they add. So we think that this company can be multiples of the size that it is today, and that's just with respect to its core product. To the extent that we deal with summer learning or after-school support or special education or mathematics or any of these other modules, this could be a breakout opportunity. So that's what we seek to do and provide within our portfolio, is finding companies who, as Les said, deliver a clear and obvious case for why it should grow, but also a significant impact story, the likes of which we want to be proud to talk about.
Mm-hmm. I love that example because, as you said, there is a clear and significant case to grow, right? So there is a capitalist argument for actually investing in that company. Roy, let me maybe bring you in here. Some of the surveys that we've done of private, and I know, sorry, it's a little bit hard, just so you know, we're having a little bit of echo on our end, but one of the surveys we've done of private capital providers has said that there are substantive barriers that they still experience when it comes to things to do with inclusive investing. There's a big gap between needed capital and committed capital. There's at least a perceived lack of investable opportunities. And so I think, you poll this audience, I'm sure anybody is going to come up with 5 or 6 different reasons why this is hard to do. Your organization is trying to make more investments in that are inclusive or maybe called impact investing. Can you talk a little bit about the types of barriers you've seen, some of the steps that you've taken to overcome those barriers in making these kinds of investments?
Yes, thank you. And it's so great to be here. I have the great advantage and special privilege to work for the Ford Foundation, which makes me my fiduciary duty is owed to the common good. So it's the people of the world. Those are the folks I owe fiduciary duty to. And because of that, I have the responsibility to say things that are direct, candid, and I do my best to be diplomatic in my language. But when we think about inclusive capitalism or inclusive investing, there's a couple different ways to look at it. One is that inclusive, at least in this country, in the US, really boils down to racial barriers. It's really, when you set aside the existential matters related to our planet, this country faces and has faced since its founding race-based bias, discrimination that has been extremely costly, extremely costly. There are some benefits to the type of exclusive investing, but they're not economic. They're psychological, and I can get to that later. So that's one. The second way I define it is the concept of stakeholder capitalism. It's the type of capitalism that Johnson & Johnson wrote about in their original credo back in 1947. And I invite all of you to take a look at that. But I raise those topics because that's what we're dealing with. We've had no problems with investing whatsoever. There is no lack of investment opportunities. That's part of the false narrative that we might hear. There's been data for decades that talk about the fact that people of color, particularly black investors, perform at or better than white male investors. I think by now many of us know the 98.6% statistic, which is the inverse, being 1.4% of the 80 plus trillion in assets under management in the US is controlled by firms owned by women and people of color. That is a travesty because that's 70% of the population that controls 1.4% of the assets. In a capitalist system, if you do not have access to capital, what you have is a problem. So for us, the biggest challenge is to maintain our cheerful persistence as we try to engage others to follow the journey that a few people have. And that is to address the racial bias issue, whether it's conscious or unconscious, in this country. Outside of the US, again, there's different issues which we can get to later, but that's been our biggest challenge and the one that gives us the greatest hope because there's so much opportunity. And if we can just embrace each other, I have a term for that, and then I'll shut up. It's called patriotic capitalism. And there's a reason why I came up with that term, which we can discuss later, but I don't want to monopolize the panel.
So that's very interesting, right? What it speaks to is this idea that there are challenges that exist within the system, meaning how do we think about getting the right financial returns? Are there investable opportunities? Do we see pockets of growth? But there are also the issues that arise outside of the financial system, which maybe then bring me, Taffi, to a question for you, which is how do you think about the role of different forms of capital, public, private, philanthropic in this regard? Well, how do you think about the role of government and policy to overcome some of the types of challenges that Roy raised and capture some of these opportunities that both Les and Greg talked about?
Well, it's always hard to follow Roy, but he's a friend and someone who I admire for his work, and I lean on quite a bit for some of the work that I've done in my role. I'm with the New York City Comptroller's Office, and we do have a diverse and emerging manager program. And part of why we do that is we took a step back to look at how is this actually driving economic returns for New York City, but most importantly, how is it driving returns for our pensioners? So we're a $275 billion pension system, and we invest for the New York City employees, the New York City firefighters, New York City police officers, the Board of Education. And it's very important that those constituents, over 70% of whom are women and people of color, see that their pension dollars are also impacting their communities. And when we looked at the returns of our diverse managers, they've generated 5% additional returns above their public market equivalent for our portfolio. So for us, it's a matter of strong returns, first off. And then secondly, we find that a lot of our diverse managers are invested in strategies that may be lower middle market, that may be niche strategies that the larger firms just have no interest in and have no bandwidth to get involved in. And these are businesses and services in communities that need them. And if our capital isn't going there, then again, like Roy said, we're not really tapping into the full potential of our economy. So what we've done over the past 2 years since Brad Lander has been controller is we're the first public pension to disclose our investments with diverse managers. Our peers who do it usually do it because there's a state law or a city law driving them to do that. But we want it to be transparent. And what we've seen is that when we started off, it was about 16.8 billion, or 11.3% of our assets. We're now up to 13% of our assets, which is about 19.5 billion invested with diverse managers. And we've set aspirational goals to grow that to 15% by 2025 and 20% by 2029. So that's over $40 billion. And we believe that we can continue to grow those returns over time and focus on that, and a lot of the distraction around diversity washing. We see it again as a strong economic engine and a returning engine for our portfolios.
So Les, I think what everybody's spoken about speaks is this idea that you can, and the point you made, right, and they've given a lot of examples around that, which is you can make money doing inclusive investing. So can we unpack a little bit? You raised the specter of all the skepticism around inclusive investing. Can we talk a little bit about what is driving the skepticism? Is there really a trade-off between financial returns and social returns? Have you encountered those trade-offs, and how do you overcome them? How do you deal with that conflict, or supposed conflict that sits?
Yeah, just to capture the breadth of the conversation here in terms of small to medium to large businesses, I think one of the biggest impediments to however you want to define inclusive investing is, to Roy's point, that at least in the U.S., is related to black folks for the most part. It's related to race. And there is a patriarchal, patronizing orientation that small is good and that's where we belong and that's what we're going to be doing. And I think that's part of the problem, is the inability on the part of a large component of this economy to understand that we can play across the entirety of the economic spectrum, whether it be from the mom and pop store that's providing services in a local community that Taffi talks about, to owning multinational enterprises that provide goods and services across the globe. There is nothing that presumes that one race can do it better than another if given the opportunity, but yet there is a continually institutionalized mindset that suggests, and if you think about it in the context of how the federal government thinks of minority business enterprises as small and disadvantaged. I don't know about you all, but I don't want to be small and disadvantaged. I want to be large and advantaged, Dan. Some of you may know of a firm called Hamilton Lane. I spent my entire career in the private equity business. And Hamilton Lane is the firm I founded with a female partner. So a Black and woman-owned firm started in a 120 square foot windowless office with a 286 PC. Now a NYCRS traded public company, market cap roughly about $6.5 billion. Nobody thinks of it as a minority-owned company or that it started as a minority-owned company, but it did. And so there's nothing that suggests that we can't operate in the same spheres, along the same spectrums, in the same ways, with equal, if not greater success in many ways, because of our unique ability to tap into an untapped market, an underserved market, as anyone else can. And so we have to start thinking about this in purely, for the most part, capitalistic ways. And if you think about it only in capitalistic ways, we'll take care of the rest.
I love that because it's turning the argument a bit on its head, right? It's actually saying that if we apply all the tools we do for traditional investing now to this arena, you actually have the potential to have.
Absolutely.
Can I bring you back in, Roy? Because we've talked a little bit about this from a US standpoint. Of course, there are issues to do with inclusive investing that extend beyond the borders of the US. How are you seeing this issue play out in other geographies? What are challenges, opportunities? And Taffi, I know when we spoke, you said that you invest a lot outside of the US as well. So maybe I'd love both of your perspectives on how do we think about this issue in a broader context and how does it translate?
So I think the race issue is pervasive throughout the globe. And when we talk about skepticism, I think what we really mean is bias. And it might be conscious, it might be unconscious. And that rears itself when you look at the way the international financial community manages capital allocations based on different countries. So when you think about what the US did post-World War II with the Marshall Plan, nearly $200 billion going into Europe versus what we do in other parts of the world that are non-European, that tends to highlight the disparities. And there are wars all over the world, but we chose to invest heavily in Europe, partly because we're a nation of European people, so we're very comfortable. It's very challenging to face the racial bias, because one of the things I learned from a great book called White Fragility is just saying words like diversity or bias can make people feel like you're calling them a racist. And it's different than that. It's almost an uncontrollable urge towards tribalism. One of the most fascinating stories of a psychological study or psychology study I've read recently was the one conducted by Stanford University, where they found in institutional investment management, where they found that the best performing Black investors face the highest bias and discrimination compared to lower performing. And there's any number of reasons one could speculate about why that is, but we see it throughout the global financial community. And I think the difficult reality is we have to embrace sort of the truth and reconciliation around this and move forward. I've been working on something with the Church Commissioners for England, and they've done that. They've taken a look at the racial bias they've had throughout history, and they're taking steps to allocate capital to make the world better, because they realize that by addressing some of the racial issues that exist in the church, they're making everyone's lives better.
So the biases that underpin investing in the U.S. also manifest outside of the U.S.?
That's been my observation, because if you look at, although that's the U.S., China, on the other hand, has poured money like a faucet, for example, into Africa. And the first time I visited, China was senior officials were in Africa having an Africa Appreciation Week. And so every country will have their different balls and chains that may slow them down. In the U.S., we've got to deal with our racial issues to make everyone better off.
Taffi, can I bring you in? I was intrigued when we spoke to hear about how much you invest outside of the U.S. So maybe you could describe that to the audience and some of the both challenges and opportunities you've experienced doing that.
Sure, and we don't invest as much as I think we should. I think that was part of our conversation. So about 82% of our investments are North America based, right? That remaining kind of 18% is majority Europe, maybe 5% or less Asia. And so when you think about LATAM or Africa, it's just a very, very small portion of the portfolio. We consider ourselves to be long-term investors. We have long time horizons. We do have a significant infrastructure portfolio. And when you look at the energy crisis that we're in and where we're going with technology and AI, 40% of the minerals needed for the just transition are on the African continent. So I would think that as long-term investors, we should be looking at opportunities to get ahead of that, right? And to partner with some of the African nations on this, because as to Roy's point, China has been there and they've been making investments. And when you speak to a lot of the local leaders and a lot of the local businesses, they would have preferred to partner with the U.S. investors. So there's a lot of education, I think, that has to happen for U.S. pensions when it comes to, investments in Latin America and in even parts of Southeast Asia as well as Africa. Part of that, I think, is going to happen, fortunately or unfortunately, is if we get locked out of, major, booms that are going to take place. I mean, 1 in 4, people on the planet will be African in the next 20 years, right? So I don't think we can move away from those statistics. I think it's for us to really grab hold and start moving forward.
So, Greg, let me bring you in. We talked about being long-term investors, looking at long-term trends. We talked about the idea that the puck has left the station, or the train has left the station. We know where the puck is going. Mm-hmm. I'm mixing my metaphors here. Where do you see the long-term trends in this space? Looking 5 years ahead, where do you want an inclusive investing to be? Where do you think it's going to be? What's your crystal ball here?
When I first got involved in the impact ecosystem, I always had the hypothesis that one of two things would happen. Either A, this would be a growth area, but always be a niche area. Or the other scenario would be that it would be subsumed and people would understand it to be what good investing looked like in the future. And I think it didn't take me long to see that as the world was evolving, the way that we look at market opportunities, just the way people will understand good investing to be. And in many ways, even in your questions, we've sort of asked some of these questions in the dispositive, which is to say, is this a legitimate way to invest money? Can you make money doing it? We don't do anywhere near enough of examining what the status quo looks like. And I would submit to you and to the audience that for really important reasons, sort of mean reversion thinking will serve you incredibly poorly, in the years to come. And I think it's something that gets probably too little attention. How much stimulative activity has been required just to achieve average to history growth rates. We've seen really nothing, analogous to this in history. This much fiscal, monetary, expansion of Fed balance sheets, even direct transfers of money and provisions to people. And part of the reason is because, and Roy made the point earlier, so much of our productive capacity ends up being concentrated in a few hands. And the idea that we ought to spread prosperity toward the edges and allow for greater levels of social and economic mobility, I had mentioned at the beginning, feels like a non-consensus idea, but increasingly this will be obvious to people. And I think when I look at the world economy and I look at what are the big things that will govern how economies move, there's some really important trends. Decarbonization is certainly one. AI and other sort of software issues is another. Demography, the aging of society, birth rates, sort of collapsing. That's really important. Changing trade flows, geopolitical tension, all those things are important. I would submit to you all that the search for social mobility and economic mobility and all the ways that people need to access it, from being upskilled and reskilled to their search for more, financial security, their ability to achieve, some reasonable levels of healthcare access. These will be things that people, enterprise, government, all are thinking about with not just their care and concern, but also real spending. So the idea about inclusive capitalism today still feels like it's something that we have to barter, for. But in the retrospective, it'll be one of the most obvious things that we could think of, which is that's not only where a lot of white space is, but it's also the thing that will need to be true for economies to continue to grow. The sort of top of the pyramid has been well monetized, and I've said for a long time, we in many ways have witnessed the 40-year death and decline of trickle-down economics, and we're moving away from a thing and towards another thing, which is to be able to really include more people and financial and economic opportunity. And I think as obvious as I continue to see it, so too will people for whom this is either representing illogic or something that's not intuitive to them. They will jump on board because the data is not at all subtle. It's all moving in that direction, that it's not just important for at the household level, but really, really increasingly important at the level of the economy.
So this is a core investment thesis that is here to stay. So we have about 5 minutes left. I want to do a lightning round with each of you. One sentence, only allowed one sentence. Roy, I'm looking at you. I'm kidding. So my lightning round question, maybe Taffi, we can start with you. In one sentence, what is the single most important change you believe needs to happen to accelerate the adoption of inclusive investing?
Well, I think I said it in my last statement, which is I do believe that education, if we can educate those who are in the investment decision-making seats around the economic benefits, the portfolio benefits, that will be the key driver.
Roy?
You sure you want me to go now? I would say embrace the notion of patriotic capitalism, which is a form of capitalism and investing that takes into account country, democracy, security, financial returns, and the common good.
That sounded pretty good. More points of demonstration will continue to obviate opposing views.
So at the risk of at the desire of pissing off people like Ed Blum, I'd like for us to lose the word diversity and make it normalization, because we are diverse as we sit here today. So let's quit making it a thing, because it is what it is, and talk about normalizing, to Roy's point about having some more normalized relationship between demographics and capital control.
Well, that I think about sums up our entire conversation. I want to thank all of our panelists, but leave you all with the hope that this is not inclusive investing as one niche session in the day. It's a core investment thesis. We know that the train has left the station. We know what our crystal ball looks like into the future, and let's not make this something that's niche, but a core part of how we invest and do business. Thank you all.
Thank you. Thanks.